Good afternoon to our CLA family, friends, colleagues, and community partners. Welcome back to our live stream. We have a jam-packed show today, so let's quickly get the housekeeping out of the way first. Please continue to send us your questions through our inbox at livestream@claconnect.com. We'll answer what we can during our session and follow up as we are able. You may also reach out to us directly for specific consultation at claconnect.com on our COVID resource page and use just the Contact Us button. Our agenda today is to cover what we know on employee payroll tax deferral, certain key global issues, the EIDL fraud, and the new IFR related to PPP loans. I'll cover the deferral, and then our esteemed guests are Kirthi Mani, who's a principal in our BizOps group, Karen Blasik, a BizOps CFO and national industry leader for restaurants, and our returning fan favorite, Jack Rybicki. Welcome, everyone. I'd like to start with a discussion of the deferral of the employee portion of Social Security tax on wages paid from September 1st, 2020 through December 31st of 2020, as directed in the presidential memorandum issued a few weeks ago. We started this conversation last week with Chastity, and we have a few more comments related to implementation. The Secretary of the Treasury must issue guidance prior to the deferral taking effect. One rumor expected a release on August 14th. Obviously, that didn't happen. Perhaps the comments by the AICPA, the U.S. Chamber of Commerce, and other groups noting items requiring guidance delayed the initial release. We don't know. Rumors are abounding, including guidance that might not be released until Labor Day, which is after September 1st, or the date that the deferral of the withholding was supposed to occur. Secretary Mnuchin noted in a press interview that the government can't force companies to defer withholding of employee Social Security taxes. That might be the best news for organizations. Deferring the withholding will require changes to payroll procedures, including payroll software. Questions abound as to when the tax will need to be paid and by whom. How will the amounts deferred be reported to the employees? What needs to change on Form W-2 and Form 941? Will the employees pay the deferred tax through Form 1040 filed for 2020? Will an employee have a choice of whether to have the Social Security tax deferred? And how will they document this choice through a new revised Form W-4? Will employers be required to provide notice to the employees that the tax was deferred and not withheld, and then the employee be responsible at a later date for payment? President Trump wants Congress to forgive the tax, but Congress may not. So what if now or later they forgive the tax, but some employers chose not to change their payroll reporting systems and continue to withhold and pay the tax? There are so many unknowns. Our advice, please discuss the complexities with your advisor and wait for guidance. I'd like to bring Kirthi into the conversation at this point to talk about some of the recent changes and opportunities you've seen in our global client base. Welcome, Kirthi. I'd like to start. Hi, let's start with just a high-level overview of what's going on.
Thanks, Jen. Delighted to be here today. Just looking at the recent challenges, it is easy to think that the COVID-19 pandemic will sink globalization. So as coronavirus-driven restrictions freeze movement of goods and people across borders, world merchandise trade is set to plummet by between 13 and 32% in 2020. Nearly all regions will suffer double-digit declines in trade volumes in 2020, with exports from North America and Asia hit hardest. But having said that, when we refer to globalization, many things cross borders, right? It's not just people and goods, there is services, money, data. So even as fewer ships plowed oceans with goods, the quantity and value of data whizzing between countries is increasing. COVID will make it harder to ship merchandise, but other things just get easier. So we all know on Zoom, it is as easy to do business in Singapore as it is with San Francisco. So I think that rather than dooming globalization, the COVID pandemic could spur it onward. There has never been a better time to embrace both the remote capability already inherent in your organization and your global outlook.
Absolutely agree. So how has COVID-19 affected foreign direct investment?
That's a good question. I think with a decline in GDP of almost like 15 to 30% expected in major economies, including the US in the second quarter of 2020, Jen, the global FDI market is in free fall. So forecasts suggest a 40% decline of greenfield FDI in 2020. But the impact will vary significantly across sectors. We all know like some sectors such as tourism, airlines, leisure and entertainment, luxury goods, oil and natural gas have been hit the hardest, with a near total collapse in demand in many of these sectors. But other sectors that we're seeing in many of our global clients, like e-commerce, e-health, medical products, ed-tech, video conferencing, and basic consumer and food and beverage products, have seen growing demand as a result of COVID-19 crisis, in some cases with spectacular growth in sales and valuations of leading companies. One good point to note is the UK was a top destination for FDI in Europe, and the UK remains attractive to investors wanting to operate within the country, and many are establishing UK-based operations to combat any effects of Brexit. We've all heard about that. So for those interested to hear more on this, I highly recommend registering for a webinar on doing business in the UK. I think there's a link to register on the YouTube page. A little bit more on FDIs, like on 2019, China was a top destination for FDI in Asia Pacific, and the US remains the top destination in this region, attracting, I think, almost 84% of FDI. California and New York remain the top two destination states in 2019 for FDI projects.
Yeah, Kirthi, I love that you mentioned the webinar coming up on September 9th, because it will go deeper in as a deeper dive into that. And probably some of these other questions too. One more that we had was, how have the U.S. relief programs like PPP and Main Street lending applied to the global companies?
Yeah, yet another great question. It has been quite the journey on this. So I read a very good article written by our CLA principals, Tim Irwin and Eric Ski. It's called, I think, the PPP eligibility for foreign-owned US subsidiaries, which cleared a lot of doubts around this topic, Jen. So historically, applications for SBA funding would preclude a foreign-owned entity because that goes against the SBA's purpose to support the growth and advancement of US businesses and entrepreneurs. So in other words, if a foreign-owned entity needed growth capital, that capital should come from the foreign parent or other sources and not from the US government. But however, foreign-owned companies are not automatically excluded from being eligible for the US relief program. So both the SBA and the Department of Treasury have published guidance on who can be included. So with the expert guidance of the CLA team, many of our global clients benefited from both the PPP and the EIDL. I've been personally seeing it firsthand. This relief has been a lifeline for these small businesses during lockdown, saving US jobs. And it has been one of the most satisfying part of my job as a trusted advisor, Jen.
Yeah, I'm sure that our clients too, I know, because I've heard they love having you as their advisor. And it's one of those points that we like to bring out and why you're here today, because you do work with clients all over the world who have staff across borders. What lessons have you learned that you can share with us about managing a global remote team?
Right. So the nature of how we work is shifting, whether due to technology advancements or generational mindset changes. The data shows that distributed, flexible, and now global teams are the future. And they're certainly the answer to creating business resiliency in times of crisis. So, Jen, some of the lessons that we have learned, number one would be a remote global team has key benefits, like whether it be access to top talent or lowering the stress and turnover. Diversity, we all know that diversity is your strength. And most importantly, I think global perspectives. Having a global team members in country is critical for any company that hopes to successfully scale at an international level. So when you have local hires who speak the local language, understand the norms and customs, and make partners and customers more comfortable, that's a huge advantage. Another second lesson I would say is legal, tax, and compliance challenges. So adding an international team member and creating a truly global team has unique challenges that need to be carefully considered. Many employee benefits not required in the US are mandatory in other countries. The US concept of at-will employment is not practiced elsewhere. So key things to keep in mind. Most countries have strict laws surrounding both terminations and severance that favor the employee more than in the US. And I think the third and the most important lesson is culture. The biggest driver of employee engagement as we work remotely boils down to one thing: culture. Research shows that 43% of employees would likely leave their companies for just a 10% pay raise elsewhere. Majority of them cited culture as the most important factor in their decisions. So take for example, our CLA family culture that creates a strong sense of belonging. loyalty and pride, right, Jen? We all have a sense of belonging to a special place. We do things differently around here, and most of us couldn't consider working anywhere else. So I think organizations must even be more intentional about cultivating this type of culture when the team is distributed and diverse. That would be the learnings.
Absolutely. And those are really valuable points I think you bring to mind. You know, we are going to move to some of the other topics on the discussion, but I don't want to let you go before I ask you about any supply chain issues that you're seeing with the manufacturers you work with.
Right. So the pandemic has made the actual nature of global supply chains plainly evident. Free and open movement of goods and services is a fine principle, but loaded with risk, as we see. And that risk is accentuated at every stage when there is a reliance on people. In fact, one of the best articles I've read about this topic is Review Your Supply Chain Strategy and Amid Coronavirus Challenges by Sam Metcalf, our CLA managing principal of M&D. So rising labor rates, tariff management, and now the COVID is putting unprecedented pressure on leaders to diversify supply strategy. And the article very beautifully mentions that supply chain changes cannot and should not be about chasing the cheapest quote. The cheapest quote may not be the cheapest price, as we all know, and it can erode promised financial gains. One interesting thing, Jen, is until now, business models based around automation, autonomous systems, and artificial intelligence have been largely theoretical. The technology has been there, but without the determination to take on the social and economic shocks involved with implementation. I think lasting impacts of the COVID-19 crisis is likely to be an acceleration towards the automation of systems and nearshoring. We may see shorter, simpler supply chains with new levels of resilience built in, as well as the all-important new levels of flexibility and adaptability in strategy and management. I think that's where the future looks like.
Yeah, that makes a lot of sense. You know, thank you, Kirti, so much for this wonderful information. I know you have that session that we mentioned coming on September 9th that will give our clients an even deeper dive into these topics. For those of you in the audience who do want to know more, please register at claconnect.com for an invitation to this event. Now, before we get to PPP, which is where we're seeing a bunch of questions coming in right now, we need to address one more key thing happening right now, which is the fraud in the EIDL program. The Office of Inspector General, in a report issued on July 28, 2020, noted that there are some strong indicators of widespread fraud in the economic injury, disaster loan, and advanced grant programs that require immediate attention and action. Karen Blasek is here to give us more information on this. So welcome, Karen.
Good to be here, Jen. Thank you very much for having me.
Thanks so much for being here. You know, I was hoping you could please start by just giving us an overview of what all that means and what is happening.
Sure. The purpose of a recent notice from the OIG was to alert depository financial institutions to the potential for suspicious activity related to COVID-19 EIDL funds deposited into business or personal accounts. They have asked these institutions to be on the lookout for suspicious activity that could be the result of identity theft or other issues, as well as asking them to respond to customer inquiries regarding monies deposited into their accounts that the customers were unaware of or not expecting. Fortunately, the SBA has published a list of those companies that had applied for and or received EIDL grants and loans. Currently, on the SBA website, there are 2 files that can be downloaded by anybody, one for EIDL grants and one for EIDL loans. We have seen examples of loans listed for CLA clients that were not actually distributed to those clients. So it's very important to contact the SBA directly if the client sees a loan listed that they didn't apply for or receive.
Yeah, that's super helpful. So what is the first thing that an organization needs to do to determine if they are at risk?
They can check these files to see if they're listed on them. I would recommend checking both the grants file and the loans file. Another red flag would be if the client is contacted by the SBA or a financial institution about making payments on an EIDL loan, which the client never received any loan documents to sign. Remember, just because a client may have filled out the online EIDL application doesn't mean they had to take the loan. In order to have the loan dispersed to them, they would have had to sign loan documents as you would for any other loan that you would receive. However, the EIDL grants were made ahead of the loans and didn't require that an EIDL loan be taken. The grants were automatic in that they came into the applicant's bank accounts with the banking information already provided in the online application form without the applicant having to sign any other paperwork.
Yeah, so if the client is listed in that file and did not get a loan, what steps do you recommend that they take?
If they did not receive an EIDL grant or loan, they should contact the SBA. EIDL.ach.inquiries@sba.gov is a good website to go to be able to send an email off to the SBA. And even though an email may seem kind of impersonal and weird for something like this, trying to get a hold of somebody at the SBA live on the telephone right now is pretty impossible to do. So they can verify the information that's showing in those files. To report a potentially fraudulent activity, you can also reach out to the OIG on their hotline number, and that's 1-800-767-0385. If you call that number, you may be redirected to a website address as well in which to send a web inquiry. So you can report loans that were listed under your company name, but were potentially fraudulent that were obtained by another party. Also, CLA has proactively cross-referenced this list from the SBA with our list of clients so that we can reach out to our clients to confirm with them if they received a loan and or grant. And if the client says they never got any loan, then we have been recommending that they then reach out to the SBA. If there's a potential fraud issue, then we recommend that the client also contact an attorney to get involved. But just know this, while this cross-reference list has been helpful to a number of our clients, it may not be all inclusive. There's also a cutoff that's listed as of June 30th. So as we know, we're a couple months later than that. So there could be additional items on that list. But obviously, if you see yourself on the list and you did not get a loan, you want to follow up on that because that could cause issues for your credit for the future and other matters.
Absolutely. Karen, thank you so much. I know you referenced a phone number and a couple of email addresses. I want everybody to know you can email the Livestream inbox if you have some questions about those contact information, or again, check us out on our COVID resource page at claconnect.com, and we can help direct you to those email addresses and that phone number. So Karen, this has been incredibly helpful. And again, I'm sure we have a lot of questions coming in for you in the inbox. So we'll definitely get to those if we can today. And then of course, to the audience, if we don't get to everything, please use the COVID resource page to reach out to us for more specific consultation. That's what we're here to do. And now I'd like to pivot to our last topic of today's session and bring Jack Rybicki back into the discussion. Hello and welcome back, Jack.
Hey, Jen, how you doing today?
I'm great. And it's so good to have you here along with our other guests. It's really, really a lot of good information today. The reason why we brought you in is that on August 24th, the SBA released an interim final rule on treatment of owners and forgiveness of certain non-payroll costs. Finally, right? Yeah. So Jack, can you give us an overview of what was in that one?
Yeah, so we've been waiting for a lot of guidance, and this actually was fairly helpful guidance. So we did get some clarity about owner-employee compensation and how that's going to be reported. And then we've been looking for guidance around topics like related party rents, or how to deal with situations where you have subleases or subtenants, things like that. And so we finally do have some guidance on that now.
Excellent. And so now that we have the guidance, what do we know with more certainty as it relates to owner employees? Let's start there.
Yeah. So the owner employee piece was actually a really good bit of news, right? Because there was a concern that anybody that had an ownership interest would have to be reported as an owner employee. And obviously there were some limitations on what you could and could not include for owner employees. And we got a lot of questions about, well, is there a de minimis threshold? All the previous guidance never gave any type of threshold. It basically said, if you were an owner employee, you had to be reported in this manner. And so for businesses that had like broad-based stock ownership plans, things like that, where you had a lot of people that might have had, a 0.5% of ownership, that reporting was going to be very cumbersome. The new guidance basically says we draw a line that says if you have 5% or less ownership, you just get treated as if you were a normal employee. You look at payments during 2020, not looking back to 2019. You don't have the same limitation. So the owner employee limitations that are out there for C Corp and S Corps only apply to those individuals that own more than 5% of the company.
I think that's some really helpful clarification. You also mentioned that we have information about the related party rents. And I know even before the session, I saw some questions coming into the inbox about that. So can you tell us what we know now as it relates to related party rents?
Yeah, this is a topic that we've been raising as a concern since the beginning, right? Because obviously, if the two entities were together, what you would be able to claim was very different than, that just that rental relationship. And, this was one that unfortunately ended up being a little bit bad guidance for borrowers, right? In that if you are in a related party rent situation, what is going to be includable as a forgivable element in your PPP loan forgiveness application is only the piece that relates to interest on a mortgage obligation at the related party that holds the building. And so, for instance, if you pay $5,000 a month in a related party rent relationship, and that other entity has debt on it, and let's say the debt is $3,000 a month of interest expense, your the rent that would be includable is only $3,000. Now take that to the extreme, and let's say you've got a related entity that has no debt on it. Unfortunately, that would say that none of the related party rent would be eligible for forgiveness. So again, at least we know now, but it wasn't a really good answer for our borrowers.
Exactly. I think that's helpful clarity, just a little more information to help guide the borrowers on a much debated topic, right? So
Yep.
Now we also have some information about non-payroll costs that came out in this IFR. Can you talk about some of that for a bit?
Yeah, the rest of the guidance really kind of dealt with unusual situations where you've got either kind of co-location in a facility or a home-based business. And if you think about it, the guidance really does make sense. It basically says that as a borrower, you can only ask for forgiveness for your out-of-pocket costs related to your facility. So for instance, if you are paying $5,000 a month rent for a place and you sublet a portion of your facility for $2,000 a month, you only get to say that $3,000, the 5 less the 2, your actual net out of pocket for that rent is eligible for forgiveness, right? And so there are other examples of that same thing. So for instance, if you actually own a building in your company, and therefore maybe you have interest expense on that company, but you rent a portion of that building to somebody else, right? So let's say you occupy 60%, but somebody else pays you rent for 40%. In that case, only 60% of the interest you incur on that mortgage obligation would be eligible for forgiveness. The 40% you're being reimbursed through the rental arrangement with that other party effectively is not subject to or eligible for forgiveness. And then the same thing goes for if you just have a co-located arrangement where there's two businesses that share rent and utilities in a single space. You're only eligible to include a portion that you're going to pay and claim on your tax return effectively. So all of those were good guidances to address somewhat unique situations, but ones that do happen quite a bit for small businesses. Now, we also did get some guidance related to home-based businesses. So these are generally, your sole practitioners or independent contractors that report on Schedule C. And for those individuals, there's been a question, can I include utilities in allocation of my house expense, those types of things? To the extent that you included it on your 2019 return on your Schedule C, you can include those types of expenses as being eligible for forgiveness. But if you did not claim them in 2019, then you will not be able to submit for forgiveness for those in your covered period.
That makes a lot of sense. And I feel like what's happening here is that we're just getting closer on more information than we've been wanting to know.
Yep.
We still have some key questions. I mean, like I said, as we inch forward, there's still so much that we're trying to get to. Can you maybe reiterate some of the things that we don't know? Because I think for a lot of people, that's almost as important, just wondering, like, gosh, is there an answer out there that I'm missing? So maybe if you could talk us through some of the key things that people, like, we still don't know. So
yep.
That would
help.
The
biggest piece that we don't know, and this really relates to folks that are going to use the 24-week covered period. We know that you can file early, but the rules around filing sometime before the end of 24 weeks and how you do those calculations are not clear yet, right? The only thing we have clarity on is how you would deal with a wage reduction in that setting. But things like, how do I calculate my FTEs? What kind of proration of the $100,000 limit that's out there related to cash compensation? How does that work? There's just a lot of questions that are out there related to filing before the end of your covered period. Even basic things like, how much can I claim for cost, right? Can I claim more than my PPP loan amount so that if I do have a reduction, the net amount still exceeds the loan amount and we can get forgiveness, right? So that's a big one that's out there. Two others I want to mention, though. One of them relates specifically to how the SBA is going to interpret whether or not you're asking for forgiveness for funds used to retain employees and what that means, right? We're really concerned that, at some point in time when the SBA is looking at these, they're going to look to see, did you need these funds to pay salaries, or were those salaries getting paid for by your customers because you didn't see a decrease in business, right? We don't know if that's going to be the case, but there's clearly a risk because of the wording they use there. We look forward to getting some guidance out on how they're going to interpret that. And that might not actually come in the form of guidance, but what that might come in the form of is the SBA actually reviewing some applications, those applications getting rejected, and as we saw, there's an appeals process now, and if those things get appealed and we start to see the outcome of some of those appeals, that might be the way we get guidance on how they're going to interpret that. The last thing I'll throw out there, and this is a tax-related item, right now the IRS has said that any expenses that are incurred but paid for by these forgivable loans will be non-deductible. There is a planning opportunity out there to wait for your forgiveness application until 2021. That way you would get to take those deductions in 2020 because you wouldn't know what your forgiveness is yet. And the benefit of that likely is not that you're going to get to take them as a deduction, because if the rules don't change, you'll have to pick that income up in 2021 is what we think. However, we're already hearing that there's going to be challenges to the IRS interpretation related to this. And this would also give Congress a little more time to take action, because we have heard that congressional intent was to allow these to be deductible. And so holding off on your application for forgiveness might give that issue time to sort itself out so you don't get a bad tax answer in 2020. So, just a few things to consider that, unfortunately, we don't know the answers to yet.
Yeah, and I think the key is, how do we navigate it when we don't know the answers?
Yeah.
I know, speaking of questions, we do have a few coming in from the inbox, and I think we still have a few minutes to take them. So if you're ready for me to, most of them, Jack, are coming your way, but Kirthi and Karen, I think we may have a few for you. So let's take what little time we have left and see what we can knock out here for our community partners here who are watching us. The first one I'm reading here, it says, I see that the FAQ clarified guidance for an owner employees of CNS Corps. What about LLCs? They're saying, we are an LLC with a number of employees with small investments. Are we able to follow the 5% threshold as well?
I would assume not, right? They were very deliberate in their language related to ownership in C corps and S corporations. They could have very easily also included owner employees of LLCs in that, but they did not. And so I would not expect that you can interpret that guidance and project it onto LLCs. I think that would be an aggressive position.
Okay, I think that's helpful. The next one we have is, if I had an employee resign, am I eligible for the PPP easy application?
No, definitely not. I mean, if you have an employee resign, then it depending on whether or not you've replaced them, right? If you replace them, then you can still make that statement that you didn't have a reduction in force that would allow you to get there. If you had somebody resign and you did not replace them, unfortunately, it does kick you out of the EZ form. However, when you do the regular form, the form 3508, you would just pro forma that back in because it was a voluntary resignation. And as a result of that, it wouldn't impact you from a FTE reduction quotient, perspective. Mm-hmm. I know the filing is a little more onerous when you do that, but you would still not be penalized for it. But you are correct that it would kick you out of the EZ filing unless you replace that person.
Okay, I think that makes a lot of sense, and that gives some clarity. We had a couple others that were in that vein. I think we're going to go to our last question before we need to wrap up here. And it says, how long do I have to file for forgiveness? I ask because the app states we need to file the 941 with the app, but my July 4th payroll won't be ready until Q3. So yeah, any chance you could comment on that?
Sure. So you actually have quite a long period of time until you have to file for forgiveness, right? So the PPP Flexibility Act that came out on June 5th gives you a 10-month window after the end of your covered period. So if you're using the 8 weeks, you've got another 10 months after that before you have to file. But practically speaking, everybody defaults to the 24 weeks, which is about 5.5 months. And so realistically, you've got about 15.5 months to file for forgiveness before anything would happen where you have to start paying your loan balance off. So you've got plenty of time to do that. Related to the 941s, we get this question a lot because people that are using the 8 weeks, or maybe they're trying to just use 10 or 11 weeks to get to forgiveness, they are lopping over into that Q3 941. What we're suggesting is a couple things there. First of all, again, we are suggesting patience in that process. Let the rules play out and, don't file earlier than you have to. However, if there is a need to file, what we're suggesting is file without the Q3 941, but acknowledge to the bank that your filing is incomplete and that you will provide that filing as soon as you have it. Now, some payroll companies that are out there realize that this is an issue, and they are providing some special reporting along those lines that maybe the banks and the SBA will take in lieu of the 941 for Q3 that obviously you won't be able to provide until that October timeframe. So there's a couple different ways to look at that, but I wouldn't, if you have to file or you feel compelled to file, I wouldn't think you would need to wait until that time. There's probably a workaround. In that case, though, just full disclosure to your bank, talk to them about it, and you'll be able to work through that.
I think that's super helpful. Well, unfortunately, that's all we have time for today. I know there are questions and more information that people are wanting also from Karen and Kirthi. So both of you, thank you so much for your time on the session today and for making yourself available through the contact us button. Just a friendly reminder, definitely read the articles and reach out to us in the ways that both Kirthi and Karen had mentioned, and please register for the global session on September 9th. Thank you guys, all of you, for your time, for you in the audience, for your engagement, for the questions. Please do what you can to continue to send those in. Contact us for more specific consultation. We'll be happy to help you. As I mentioned earlier, We also have the Unlocking Cash during COVID-19 webinar series. Yesterday, some of my colleagues and I spoke on that with regard to the payroll tax credits, and we have a lot of great sessions coming up over the next 4 weeks. You can register for all of these things on our COVID resource page or by subscribing to our emails using the link in the dialog box below me. Well, we're taking a break next week going into the Labor Day holiday weekend, but we'll be back with more updates and current information the following Thursday. Until then, please stay safe and healthy, and thanks for watching.
Thanks, everybody.